All right. So, any questions before we get started? So, what we're going to talk about today is I'm going to do a little bit of a review about housing policies. And specifically, I'm going to tie them into banking policies.
Wait, one quick question.
Sure.
I had found it. Okay, so my paper was talking about discrimination.
Right.
But it's talking about feminists with decision making. That's good, right?
It could be. Do you know what's the source of it on the paper?
What you mean?
Like, where's the article from?
The Guardian.
Okay. Yeah, that could be good. Yeah. All right. Other questions, Cameron? No. All right. So what we're going to do is we're going to talk. I'm going to briefly review some of the housing policies we talked about, and then add in some banking policies this time. Then I'm going to do a little bit of an overview of the housing crisis. Talk about what the main issues were in terms of what were the, kind of like just what's the shorthand version of what went wrong in the housing market that led to the bursting of the bubble and the financial crisis that ensued. So in my view, just kind of like what the high points are. And then finally, I'm going to talk about specifically the giant pool of money and the housing crisis. So how did we actually get to the point where we had, 10% of all loans that had been given out in terms of total mortgages being in some state of foreclosure in 2008, and then it ended up being 15% by 2009? How is this how did we actually go through that process? And I'm also going to link to a video that is already actually up on the website, but you guys probably haven't seen it unless you clicked around the entirety of Blackboard. So talk about housing policies and specifically some banking related policies here. So first things first, we talked about a couple different banking policies last time, or housing policies. Remember, we made the argument that it may be in the government's interest to support people getting into their own houses. And so in 1934, the National Housing Act created the Federal Housing Administration. Now, let's think about this. 1934, what was going on in the United States?
Depression.
There's a depression, right? So you had all sorts of New Deal policies that were going on at the time. Things like the creation of jobs through the Civilian Conservation Corps, through the Works Progress Administration. You had the founding of of Social Security that happened a year after this. So all sorts of activist policies that were trying to help out people, especially responding to the Great Depression. One of the most visible signs of poverty, as we talked about last time, is what's going on with people's ability to live in a house. And so homelessness was a huge issue during the Great Depression. And so the National Housing Administration, or the National Housing Act and the Federal Housing Administration, came out of those issues. Now, when we think about other policies that came about, we also talked about what ended up becoming the two of the main agencies that are often blamed for the financial crisis. So we have the Federal National Mortgage. Is it Federal National, actually? Yeah, Federal National Mortgage Association. That was actually created in 1938. Again, out of the Great Depression. And this became known as Fannie Mae. And then we had the Federal Home Loan Mortgage Corporation. And essentially, it was seen that Fannie Mae wasn't doing all of its job, and so this was created in 1970, and this became known as Freddie Mac. Now, both of these basically play the same role, and these are both government-sponsored entities, or enterprises. So they're not actually part of the federal government. They're government-sponsored, but they're not part of the federal government. It's not unlike, what's one way of thinking about it? I don't know, the way that I think about it a little bit is kind of like the foundation. Do you guys know what the foundation is here around here? Like, have you heard about like the USM, the Southern Miss Foundation? So it's associated with the university, but it's not really part of the university. Like, we support it, like we help decide who gets to run it, like we run the searches for that and everything, but they have their own pool of money and they fund their own thing, and they pay for football stuff that we can't use state money for. They pay for things in the honors college. They pay partially for form. They pay for things in our department as well that the state government won't pay for. So we're associated with them, and they're kind of sponsored by us, but they're not really part of the government. And this is the same thing with Fannie Mae and Freddie Mac, is that they're both quasi-governmental, government-sponsored enterprises. And they both, their goal was to increase the secondary, that's I'm trying to use second and then area, that doesn't work. I'll just secondary market for mortgages. And we'll talk more about this in just a minute, about what this secondary market for mortgages. But the idea is that I'm going to be more willing to write a mortgage to someone if I don't think I have to keep it on my balance sheet as a bank the entire time. If I think possibly someone else will buy this mortgage from me. And so this is a way of creating more liquidity in the mortgage market, or more thickness in the mortgage market, in that it just encourages banks to go ahead and do this. Now, the Federal Housing Administration, one of the things that it does is actually subsidize these housing loans, which means that there are going to be more mortgages written as well. So all of this kind of increases the willingness of banks to write mortgages. It's not writing the mortgages themselves, but it's encouraging banks to write mortgages. And so this, if banks are encouraged to write mortgages, more people get mortgages, more people can afford a house. That's the basic idea. Now, all of those are laws that are related to mortgages and houses. But another set of laws that are related to this, and all this stuff is going to come together when we start talking about the financial crisis, have to do with banks. So who are writing these mortgages? Well, banks are. So the laws that govern banking are also going to be part of this story too. Three main laws that I'm going to talk about. Two of them play a big role in the story that we're going to tell about the financial crisis. One of them is kind of like afterwards, and you hear a lot about it now, so we need to go ahead and talk about it. The first one is from 1933, and this is the Glass-Steagall Act. Again, 1933, right? What is this a response to? The Great Depression. One of the big problems that people saw during the Great Depression is that during this time, there was a lot of kind of funny business going on in the financial markets, right? That banks were using consumers' money. Like, you'd go and deposit your money in the bank, right? So you get your student loan check, you go and deposit in the bank so you can pay for textbooks later on, whatever. So you deposit in the bank, and then the bank would take your money, and then they'd go and like buy risky securities with it. They'd go invest in the stock market. They'd go gamble it away, essentially. And so when the stock market crashed, guess what? The banks were losing your money in the stock market, even though you thought you just deposited in the bank and you'd be able to get it, right? So the Glass-Steagall Act came around and said, you know what? We don't like banks doing that. We don't like banks taking your money as a deposit and then doing crazy stuff with it. So what it said is that there had to be a division between what was known as commercial banks and investment banks. So there had to be a separation between these two kinds of entities, between a commercial bank and an investment bank. Now, what's a commercial bank? Wells Fargo is a commercial bank, right? You know, Hancock Bank is a commercial bank, right? Any of the banks that you would think you're going to go and open up an account and you're going to, you know, have your checking account or whatever there, those are commercial banks. What's an investment bank? Well, those are the entities that go out and actually create financing for a big company to be able to run their business. So if you're GM and you want to figure out a way to build a new $60 million factory, well, you're not going to go just to a commercial bank and say, hey, by the way, I need to borrow $60 million today. They're going to say, oh, maybe what we're going to do is we're going to help you finance this by offering some more, you're going to, you know, float some more stock. Or not even just 60 million, you know, maybe they want to make a $1 billion investment in a bunch of different plants throughout Mexico. You know, and to be able to do so, they're going to have to raise tons of money. And the way that they're going to do that is through an investment bank, either by, you know, offering more, by issuing their own debt, or they're going to offer more stock, or they're going to try to, you know, somehow finagle a big financial deal. And so these commercial banks, you know, these are what people call like retail banks. So you think about it as, you know, where mom and pop go. So they take money from depositors. And they'll make small loans. You know, they'll make your car loans. They'll make your mortgage loans. They'll make loans to, like, if Bops, you know, wanted to redo that store, like when they do that, if they wanted to go to Hancock Bank, sure, Wells Fargo would do something like that. So they take money from depositors, and then they make small loans. These investment banks are things that finance large operations. And the way I often think about this is like they're GM trying to do something, or it's like even bigger than that. It's like creating their own paper, right? If you have to create your own like debt instrument because you're so big and you want to get $100 million out there, then you're going to need to go to an investment bank to do that. You're not going to be able to go just down to your local Wells Fargo and get $100 million, right? So they said that there's got to be a clear line between these two. And these investment banks, the way that they can create a lot of money is that they can play in the stock market. These guys can't. So this is the wall that Glass-Steagall made, was between these two. And think about these guys, it's more like Wall Street, and these guys are Main Street. Okay, so they're both banks, but they play in different worlds. All right. And Glass-Steagall was the law of the land in the United States and said these two things are not the same. They have different rules, well, different regulations. And the key thing is that if you're a commercial bank, you can't play on Wall Street. If you're a Wall Street bank, you can't go out there and start getting deposits from, you know, from Joe Schmo, you know, in Hattiesburg, Mississippi. So you had to separate the two. Now, what happened then is that there's all sorts of financial innovation. You know, all sorts of, you know, different kinds of loans were being made, all different kinds of deposits were being made. We had, you know, 1933, you got to figure there wasn't, you know, huge British and, you know, Japanese banks working in the United States. There weren't, you know, there weren't banks that had operations in, you know, 30 different countries and had these global operations. So things changed over time. In the 1980s is a time of high finance. And slowly throughout the 1980s, during this Wall Street boom and crash, people were like, you know, Glass-Steagall's just out of date. And so in 1999, a new act was passed, which is the Gramm-Leach-Bliley Act, or GLBA. These are all senators. Phil Gramm was our illustrious senator from Texas, ran for president in, when did he run for president? 92? 96 maybe? I think maybe 96 he ran for president. By about this time he was close to dropping out. It's one of those sorts of things, kind of like on the Marco Rubio, Ben Carson sort of level before he dropped out. So Gramm-Leach-Bliley Act, and this basically repealed Glass-Steagall. And the writing was on the wall. Glass-Steagall was almost dead already because in 1998, so this is in 1999, in 1998, just a year before, you had Citibank and Travelers Group. So this was a commercial bank. And this was an insurance company. And so insurance companies, how do they make their money? Well, they take insurance payments, right? They take life insurance payments and they turn around, they invest it in something else that has a higher return, like stocks and bonds and all that sort of stuff. So these guys play a lot on Wall Street. This guy wasn't allowed to play on Wall Street, but in 1998, the Federal Reserve actually offered a waiver to the Glass-Steagall Act to allow this merger to take place. And what's the new company called? You guys heard of this before? It's rather inventive. Citigroup. So they took just that, Anyway, so Citigroup came out of this in 1998. And they were allowed to both be a commercial bank and an investment bank at the same time. Once these waivers started being allowed, everyone said, well, there's no real wall between the two anyway. If this is going to be allowed to happen, then every commercial bank that wants to play on Wall Street is just at a kind of a disadvantage because of Glass-Steagall, so we might as well just go ahead and get rid of it. By the way, who was the president in 1999?
Clinton.
Clinton was the president. So these guys were largely Republicans, right? I think all three of them were Republicans. Maybe Bliley wasn't. But these guys were Republicans, but then the president was a Democrat. So it's not a partisan issue at all, right? They're both on board. And so when people say, oh, the financial crisis due to this party or that party, they're both culpable in this. Clinton was all for breaking down Glass-Steagall as well. But it was already somewhat on the ropes. Okay, so that's the two that preceded the crisis. Then we have the one that came about afterwards. And this was Dodd-Frank. And so technically it's known as something like the Dodd-Frank, let's see if I have the full name in here somewhere. It's like Dodd-Frank Consumer Protection Law or something like that. And this basically created regulations to prevent another financial crisis without reinstating Glass-Steagall. Essentially what they decided to do was just regulate every sort of big transaction. So if you wanted to be a commercial bank and play on Wall Street, that was fine, but you had to show that you had plenty of assets to back it up in case you screwed up. If you wanted to create certain types of securities, you had to go past, jump over all these hurdles first. And so the idea was that it was just going to slow everything down and just make sure some of the worst violations that happened during the 2007, 2008, 2009 financial crisis weren't going to happen again. In general, a lot of people are not big fans of this, right? Business people hate this. It makes their job much more difficult. The banking regulations are much more difficult than everything else. But some people say, well, it's a regulation that needs to occur in order to prevent us from getting into another financial crisis, which happened before. Some people still think we're not out of the woods entirely, that we may still get another sort of bubble like what happened in 2000 to 2006, 2007. All right, so let's talk about what happened with the housing bubble. So I'm going to claim that the proximate causes of the housing bubble were the following. The first thing is that you had an increase in liquid assets throughout the world. This was because of growth in China. This was because of high price of oil at the time. Lots of reasons, but there are a lot of countries, and largely these were sovereign wealth funds. So there's a large increase in the amount of money that was looking for a good investment. In addition to that, though, we also had an issue of interest rates were low. We had the additional factor of standards on mortgages were relaxed. And then finally, we had lack of oversight in the financial sector. And some people say that's specifically because of Graham Leach Liley. That because of Gliba, in other words, because of overturning Glass-Steagall, we ended up with a much weaker financial regulatory regime, which led to all the bad stuff that ended up happening because of what could have been isolated in the mortgage sector got spread throughout the entire economy. Now, has anyone seen The Big Short?
No, but McBride talked about it.
Okay. If you haven't seen it, I would definitely suggest reading it or listening to it or reading excerpts from it. It's really, really well done. Basically, The Big Short tells the story of the financial crisis, but instead of the people that screwed up, it's from the perspective of the people that actually saw it coming. Because everyone says, oh, no one saw it coming, no one saw it coming. I personally kept on predicting something was going to happen with housing prices, every year from about 2004, because it just seemed like it's unsustainable if you just looked at the increase in the price of housing. However, it took until 2007, 2008 before anything actually started happening. It was so much, I felt like I was Chicken Little because I was just like, no, housing prices must fall because they've been going up so strongly. Well, next year they keep on going up, keep on going up. I didn't have money to make money off of it, but it seemed like it was pretty obvious that it was a bubble and it was going to burst. However, Big Short, the movie, does definitely a very interesting job of explaining how, how all this stuff works in a fairly straightforward way. I'm going to try to do a little bit of that, but I'm also going to link to some videos because sometimes better visual representations help. So we're going to talk about this now. How did all this stuff come about? Well, let's start with this giant pool of money. So in 1979, the Chinese started opening up their economy. Before that, it was completely closed. It was incredibly underdeveloped. It was restricted by trade. It didn't trade much with the rest of the world, but it did educate their people a whole lot. And so you had a whole lot of really educated people, but not a very developed economy. Starting in 1979, they started opening it up. In 1990, they started really interacting with the rest of the world because they started joining the World Trade Organization and other international treaties, which meant that they were able to start selling stuff abroad. And when they started selling stuff, all that money started flowing into China, and they're looking for something to do with that. By 2002, we had an increase in what was known as liquid assets. So this basically, think about this as cash, from about 36 trillion a few years previously to 72 trillion. So this all took place in about 5 to 6 years, right? So in the latter half of the 1990s, you had this dramatic increase in the amount of cash that was available. And this was sometimes like the Saudis had this money. You had other countries like, Nigeria started developing their oil fields. All of this money was just floating out there. So if you're cash rich, let's say, you get a big raise and you don't want to change your living style, you don't want to do anything else with it, all of a sudden you're earning, $10,000 a year, now you're earning $100,000 a year. What are you going to do with it? Now, a lot of people would say, well, I'm going to go buy stuff. But if you think maybe in 2 years you're going to be back to $10,000, what would you prefer to do with it?
Invest it.
Invest it somehow. You'd like to earn some return because you don't know how long the good times are going to last. So all of this money was looking for a good investment. That's what they were trying to do. And so they're like, okay, we want something that's super safe and gets high return. So where to invest? That was the question. So where are you going to invest this $72 trillion that's out there? Well, one place they really like is government securities. Government securities are great, right? They earn, a fixed rate of return. And the nice thing about the federal government is, when was the last time that the U.S. federal government defaulted on its debt?
Andrew Jackson.
Yeah, I mean, it's been a really long time, right? So Hamilton, writing in the Federalist Papers, one of his big things was that we cannot, we have to pay back all of our, pay back all of our, loans that we took out to run our Revolutionary War. We can't default. I don't care if, we're a new country. We have to set a good precedent. It's been years and years and years. So government securities, basically since we had a Federal Reserve, we had not defaulted on our debts. Do you have a question? Can you not read my handwriting?
All good.
Okay. So government securities are great. The problem is that the interest rates in 2000 to 2002 were very low. Less than 1% oftentimes on these government securities. Remember what happened in 99, 2000. At that time, we had the dot-com bust, and we had a really slow recovery, and so the Federal Reserve is partially responsible for making sure that there's enough demand in the economy by having really low interest rates, so allowing people to take out loans really cheaply. Well, the problem is that it's great for people that want to borrow money, but not great for people that want to save money in government securities. So the giant pool of money was like, I love government securities, but it's a really crap interest rate right now, so what am I going to do? Well, what's almost as secure as the federal government? Oh, I know. How about mortgages?
Did I say 10%?
Less than 1%.
1%.
Sorry, yeah, less than 1%. Mortgage-backed securities are great too. Why? Well, think about it. Unlike a student loan, right? Student loans aren't a bad thing either, but unlike a student loan, right? You can take out a student loan, and is there any guarantee that lender, that bank is going to get their money back?
No.
Not necessarily. Like, what could you do? You could go spend that money, and could you get a better job and finish college and learn lots to pay it back? Sure, you could do that. Or you could drop out and not have a better job and decide not to pay it back. But the key thing about mortgages is that if someone takes out a mortgage, what do you know is still going to be there unless Hurricane Katrina hits? The house is still going to be there, right? And like you could predict down to like 3 decimal places how many mortgages are going to go into default every single year. It's a very predictable thing, right? Based upon the standards that they have for giving out mortgages, that only a certain number are going to go into default. So as long as this is a well-averaged kind of security, then your default rate's going to be very low. The house is going to be there. People are always going to be able to get it. So mortgage-backed securities, they said, this is what I want, right? I can't get this. This is a crap rate, but maybe I'll be able to get like 5% on my mortgage-backed securities, and we know that those are basically guaranteed. So these mortgage-backed securities, again, why did these start coming about? Fannie and Freddie, right? Fannie and Freddie helped create this market for mortgage-backed securities. The way to think about a mortgage-backed security is that you take a mortgage, right? So you have all these different houses, and they all have mortgages that are attached to them. Mortgage, mortgage, mortgage. And you have just multiple of these. And you take these mortgages, and you put all the mortgages, all these pieces of paper, in a big box, right? So let's say, each of these mortgages, everyone's paying 6%, 6%, 6%, right? And you know that if you have 100 of these, that one of them is going to default, and so they're not going to be paying that money back. And so you take all these mortgages and you sell shares of the mortgage to different people, and you're telling them you can earn 5% on each one of these shares. You'll own, you'll own 1/99th of this pool of mortgages, and we're going to give you 5% because we know that there's going to be one in there. So there's just going to be one stinker that's not going to pay, and so we can pay out 5%, and we'll take a little bit of a cut for ourselves too, right? So this is the idea, is that you collect all these mortgages, and you basically create a new loan that's based upon these mortgages, and you pay people based upon that, right? So they are buying this box of mortgages, right? That's what a mortgage-backed security is. Well, this looks great, especially because you're earning 5% on all of these mortgages. The problem is that how many houses are there at any given time, as far as like how many houses are being bought and sold and new mortgages being created? It's pretty fixed, right? Like once all the houses have been built and everyone has a house, what do? Well, the giant pool of money is like, we want more of these mortgage-backed securities, but there are only a certain number out there because there are only a certain number of houses, right? There may be, an extra 10,000 houses that are being built every year, but that's not enough to to satisfy the demand for these mortgage-backed securities. So how do you generate more mortgage-backed securities?
Write bad mortgages.
you write more mortgages, which means that some of these people, these are all people that qualified, but you know that there's some other guy that didn't qualify, right? Someone wants a mortgage over here, someone wants one but didn't qualify, right? There's some guy that's sitting out here, and you give him a mortgage, maybe you make him pay 7%, right? Because he's more of a risk, but you figure if you get enough of these people, you can still write a similar mortgage-backed security, right? So this is what ended up happening. You had this situation where this giant pool of money was looking for mortgages, they couldn't get them, and so the people writing these mortgages, these mortgage-backed securities, they would call up the people that write the mortgages and say, we need more mortgages, and they'd say, I can't write any of the ones with the qualifying, with the qualifications that we generally use. And they're like, well, then lower the qualifications. So we went through this cycle where you had to verify income and verify assets. Right? And so it's a VI-VA loan. You had to bring in your W-2 that showed how much you got paid. You had to bring in your pay stub. You had to bring in your bank balance sheets and everything else and show how much money you had in order for them to write your loans. So this was, these were the loans had to be given. In order to get a loan, you had to verify your income, verify your assets. Then it got to the point where you had to verify your income, but you only had to state your assets. So you didn't have to bring in any documentation. You just had to write down the number, right? And we trust you, okay? You say how much money you have in the bank, we'll trust you that you have that much. Then it got to where you could state your income and state your asset. And then you could state your income, and then they wouldn't even ask you about your assets. And then eventually it got to the point where you wouldn't have to state your income or really state your assets. They wouldn't even ask you about these things, right? They just say basically, how much mortgage do you make? Write down, a number that you think you can pay, and they started giving out these loans. So you have these stories where there's this guy who's working 3 part-time jobs, right? He's 37 years old. He has 3 kids from 2 different women. He's been unemployed a lot of the last 4 years, but he's working 3 different part-time jobs. And he goes to the bank, and they give him a $540,000 loan in order to buy a house, right? He's only earning $45,000 a year, but he's able to buy a $500,000 house. Why? Because these are liar loans, right? They're asking you just to, you tell us a number that you want, and we'll basically write this for you.
Would that have to be like interest only, like for him to be able to make those payments?
And so normally what they do is they'd start off in some sort of exotic arrangement where it'd either be interest only or it'd be an ARM, right? Oftentimes these loans were also adjustable rates. And so they'd start off with some teaser rate, let's say it'd be 3%, and then after 2 years, a higher rate would kick in, which might be 10% plus the prime rate at the time. right? So it'd go from 3% to, let's say, 15%. And the payment would escalate as well. So it may go from like $600 a month to $2,000, $2,500 a month, just like that after 24 months. These started coming about really in 2004, 2005. They started writing these adjustable rate mortgages with 24 months of kind of a low teaser rate that were going to kick in 24 months. Now, why did no one worry about this thing? Why did no one see this whole thing coming? What's the general trend in housing prices?
It goes up.
They go up. So they're like, okay, let's say this guy doesn't actually have the money to pay for the higher rate when it comes about in 2006, 2007. No big deal. His house that he bought for $540,000 is going to be worth $600,000, $700,000. We'll just collect the house, and now we have a $700,000 asset that we can go and sell, and it'll be just fine. We don't care about that because we're going to have the asset. All right? So this was the mentality of everyone that was kind of in this game at the time. Well, sure enough, what ends up happening? Started getting a little bit of inflation in the mid-2000s. And so the Fed, instead of keeping interest rates low like they had been, started increasing interest rates. And that means that these arms start adjusting upward. And you end up having more and more and more mortgages that start failing. Well, you go from, like I was saying before, from about a 9% foreclosure rate to a 15% foreclosure rate. And this was happening, let's say, 2008 to 2009. Well, if the houses in your neighborhood are all for sale because they've been foreclosed upon, what's going to happen to the price of your house? Is it going to go up? If there are a bunch of houses for sale in your neighborhood that can't be sold?
No.
No. So banks are foreclosing on these houses. All these extra houses are on the market. That's going to start pushing down housing prices, which means more and more people start foreclosing because guess what? Now they can't resell their house. The banks are trying to get their money back. No one wants these mortgage-backed securities because now instead of turning around 5%, they're incredibly toxic. And so they're not able to repay all the people that took out those mortgage-backed securities that bought those shares. They can't pay them their 5% anymore. And so those start failing. And all of these huge investment banks have all these trillions of dollars and billions of dollars, usually tens of billions of dollars, that are wrapped up in all these mortgage-backed securities, and these things aren't paying anymore. And all of a sudden, the banks are worried about whether or not they're going to be able to pay back their creditors and be able to make, they're worried about defaulting on their loans as well. So in 2007, you started seeing these foreclosure rates start to tick up. Then in 2008, in March, you had Bear Stearns go bankrupt. Bankrupt? I can't spell. Bankrupt. And get bailed out by the feds. Well, they weren't the only ones that had, this is one of these investment banks, right? They had all these mortgage-backed securities. Well, throughout the summer of 2008, you had other banks like Lehman Brothers that also had all this stuff that was out there, that people were worried about them being exposed to all these mortgage-backed securities that were going to fail. Well, even worse, Lehman Brothers starts failing. They're not able to to pay off their creditors. But the crazy thing about what happened is that Lehman Brothers wasn't just in the mortgage-backed security business. None of these companies were. Instead, they were tied in with all sorts of financial markets, all sorts of things that were going on. I had lunch with a former student, and this is in September, right before September 15th is when Lehman Brothers went under. Right before then, I was having lunch with her, and she goes, this whole Lehman thing is really screwing up my job. And I said, well, what's going on? She said, my employer is an electricity provider, but we're looking at building a new grid system in Brazil, right? They're going to do something like that. And the people that are the underwriters for this, so the ones that are providing the insurance for this, essentially, was Lehman Brothers. Like, they were brokering that deal. And if Lehman Brothers doesn't exist, they can't make that deal that's down in Brazil that's tied to her job. And so that's going to freeze that up. And so Lehman Brothers and Bear Stearns and Citigroup and all these other investment banks, because they're tied to so many different businesses, like they're guaranteeing trade deals, they're guaranteeing infrastructure deals, all this sort of stuff is tied to them, all of a sudden no one starts giving out loans. Because everybody's worried about whether or not they're going to be able to make their loan payments, so no one's going to be willing to make any more loans. And so in 2008, when Lehman Brothers, so in September 15th, 2008, Lehman Brothers fails. When Lehman Brothers fails, everybody gets spooked, and no one trusts the banks to be able to exist the next day. All of these companies that had lots of mortgages and lots of mortgage-backed securities, companies like Wachovia, that's who we had our mortgage with, right? They had invested heavily in mortgages throughout the Southeast, including Florida, and guess what? Florida was a nightmare by 2008, 2009. Over 40% of all the foreclosures that happened in the United States during those years were in Florida and California combined, those two states. 70% of them were in 10 states, right? So this was very isolated, heavily affected. Florida, California, Nevada was really, really bad. Las Vegas area, still there are places that are ghost towns there because there was so much building, because there was so much easy money to build, but then when the banks started failing, there were too many houses and they couldn't sell it. So credit markets start freezing up, no one's willing to make a deal, and everyone was worried that the entire financial system was going to collapse. We're still recovering from this. You know, the Greek default that ended up happening in 2009, 2010, they're worrying about Greece falling out of the euro. All of those knock-on effects, European growth is still slow. All of that stuff that's going on is still left over from this whole thing that happened starting in the U.S. housing market, ended up spreading throughout the world. Other places also have things like what was going on in the United States, but really most of this started with the U.S. housing market. If we hadn't gone through what we did, we wouldn't have the Greek crisis the way we did. Ireland wouldn't have failed the way it did, etc. So I'm going to leave it at that, but I'm also going to link to this other video for you guys to watch. It's only about 10 or 15 minutes, and then I'm going to link to a couple other things to watch. There are really great movies about this. If you ever get a chance to watch the movie Too Big to Fail, I think it's an HBO movie. It's got great actors playing all these folks and talking about this Lehman failure, and it's really kind of like what's going on behind the scenes between the government trying to save Lehman Brothers and the bankers trying to figure out whether or not they can get a better deal out of it and everything else. But all this stuff is pretty interesting. So, all right, on Tuesday we're going to talk about healthcare, and then the exam is going to be on Wednesday through Friday. But if you wanted to have it proctored here, you can just come here next Thursday at 3:50. All right, cool.